Welcome back, everybody. Today, we're going deep on pairs trading.
Pairs trading.
Yeah, how to make money no matter which way the market goes.
Right.
We're going to be looking at this through the lens of Perry Kaufman's book on algorithmic trading.
Okay.
So, that's a fancy way of saying we're using data and rules to make decisions.
Mm-hmm.
So by the end of this, you'll understand the basics, how to pick the right pairs, and of course, how to manage your risk.
Right.
We're even going to look at some real-world examples, both good or bad.
Oh, great.
Yeah, so you can really get a feel for how this all works.
It's like having a roadmap,
Oh, I like that analogy.
Yeah.
A roadmap.
Yeah.
So let's break it down. What exactly is pairs trading?
Okay, so at its core, pairs trading is about finding two assets that generally move together.
Okay.
Could be stocks, commodities, you name it.
Mm-hmm.
They're like two best friends that follow each other around,
Okay.
even if they wander off in different directions for a bit.
Gotcha. So we're looking for these best friend assets. What's the
Okay.
goal here?
Well, the goal is to profit from those moments when they drift apart.
Okay.
We're betting that their prices will eventually converge back to their historical relationship.
So you're not trying to predict which asset will go up or down. Or just trying to see when their relationship gets out of whack.
Exactly. It's a market-neutral approach.
Okay.
So we're aiming to make money whether the market goes up or down.
So hold on. How does that actually work? Does that mean if one asset goes up, the other automatically goes down?
Not necessarily.
Yeah.
It's more nuanced than that.
Okay.
Let's say you have a pair, asset A and asset B.
Mm-hmm.
If A jumps up more than expected compared to B,
Okay.
we might sell A and buy B,
Interesting.
betting that those prices will rebalance,
Hmm.
based on their historical pattern.
So it's like a little tug of war.
That's a good way to think about it.
Yeah.
But picking the right pairs is crucial.
Mhm.
You wouldn't just pick any two random friends, right?
Definitely not. So how do we go about finding those best friend assets that are ripe for pairs trading?
Correlation is key.
Correlation.
Yeah, it tells you how closely two asset prices move together.
Gotcha.
Now, Kaufman suggests aiming for a correlation between 0.35 and 0.80.
Okay.
That sweet spot offers a good balance between profit and risk.
So what happens if the correlation is too high or too low?
Okay, so think of it like a dance.
Okay.
If the correlation's too high, above 0.90,
Mm-hmm.
the assets are practically glued together.
Okay.
So there's not much room for profit when they drift apart.
Mm-hmm.
On the other hand, if it's below 0.35,
Yeah.
the relationship might be too casual.
Too casual.
Yeah, if, like they're just acquaintances at a party, not really moving together.
Gotcha. So finding that Goldilocks correlation is key. What else should we think about when picking pairs?
Time frame matters a lot.
Okay.
Are you looking for short-term trades or longer-term opportunities?
Right. So time frame meaning the length of time you're looking at the price data.
Exactly. Shorter time frames like minutes or hours tend to be dominated by noise. Those random price blips.
Oh, right.
Now, this noise can actually be good for pairs trading. Think of it like catching those quick little missteps in the dance.
Oh, so you're looking for the stumbles.
Precisely.
Yeah.
Now, if you're looking at longer time frames like days or weeks,
Yeah.
you're focusing more on the overall trend.
Gotcha.
So that might be good for other strategies, but it's not as ideal for pairs trading.
So short term for quick fluctuations, long term for those broader trends.
Exactly.
But how do we manage the risks once we've actually found a pair that we think might work?
Well, one essential tool is volatility adjustment.
Okay.
Even in a correlated pair, each asset might have its own level of volatility.
Right. So one's breakdancing, the other's waltzing.
Exactly. We adjust the position size based on that volatility
Okay.
to ensure balanced risk.
So you're making sure both dancers have equal influence over the routine.
Exactly.
Yeah.
How much do we invest overall?
Is there a way to control the risk?
Yeah, that's where target volatility comes in.
Okay.
It's like your risk dial. Let's say you're comfortable with your portfolio moving within a 12% range.
Right. 12% is my comfort zone.
That becomes your guidepost.
Okay, great. So we've got correlation timeframes, volatility adjustment, target volatility. It's a lot. But let's say we have all that figured out.
Yeah.
How do we actually spot those trading signals? What tells us when to buy or sell?
There are a few methods, and one that Kaufman describes is called momentum difference.
Okay.
It sounds complex, but imagine you have a dashboard
Okay.
that tells you which stock is gaining steam and which one is lagging behind.
Okay, I like that visual.
Yeah, so it uses something called stochastic indicators.
Stochastic indicator.
Yeah, they measure each asset's momentum,
Mm-hmm.
like how much pep they have in their step.
Gotcha.
And we're looking for when the difference in their momentum exceeds a certain point.
So it's a trigger point.
Exactly.
Mm.
When that momentum difference gets too big, it's time to jump in.
Gotcha. So it's like they're starting to dance out of sync.
Exactly. But Kaufman also has his own unique method called the stress indicator.
Oh, a secret weapon.
Yeah, and he believes it's more flexible.
More flexible.
How so? It adjusts to the market's mood swings. The momentum difference method uses fixed thresholds, which aren't always ideal.
Right.
The stress indicator is more dynamic, constantly recalibrating.
So it's like having a dance partner that can adapt their style.
Exactly. But it might give you more trading signals than the momentum difference method,
Okay.
which could be good or bad depending on your style.
Right. Some people like to dance all night. Others like to sit a few out.
Exactly. And that brings us to some real-world examples.
Yes, let's get to the real stuff.
Yeah, where we can see how these concepts play out.
Awesome. I'm excited.
Let's start with a successful pairing. Dell and Hewlett-Packard, back in the early 2000s.
Mm-hmm. Two tech giants. What happened there?
Well, their stock prices had this interesting seesaw pattern for over a decade.
Oh, wow.
Dell was leading the dance for the first 5 years. Then HP took over around 2006.
It wasn't just a steady correlation,
Wow.
more like a shifting dynamic.
Precisely. And that's what makes it a great example.
Right.
Now, a fundamental investor might try to predict which company would do better.
Right, based on their business models.
Right.
Like Dell's high profit margins might not do as well when competition increases, whereas HP might handle that kind of pressure better.
Exactly.
Yeah.
But remember, we're focusing on a systematic approach here.
Mm-hmm.
We're not trying to outsmart the market.
Okay,
We're just trying to exploit those moments when prices diverge from their relationship.
got it. So we're letting the data guide us, not our opinions. So how did this play out with Dell and HP?
Okay, so Kaufman looked at the ratio of their prices, Dell divided by HP.
Mhm.
He focused on the long-term trend using a 200-day moving average.
Hold on, 200-day moving average. Isn't that a bit slow to react to today's fast-paced market?
Well, it might seem that way, but remember, we're aiming for those longer-term divergences.
Right.
We're smoothing out the noise and focusing on the underlying trend. Think of it like watching the flow of the dance routine.
Okay, that clarifies it. So you're looking at the 200-day moving average to spot when one consistently outperforms the other over a long period.
Precisely. The trading signals come when that ratio crosses above or below that 200-day moving average.
Okay,
It's like capturing when those dancers break formation.
gotcha. I'm starting to see how the pieces fit together. But before we get into those trading signals, let's revisit volatility adjustment. How did that work with Dell and HP?
Okay, so it's a crucial step.
Right.
We need to make sure our dancers have equal footing.
Mm-hmm.
So Kaufman used the average true range over the past 120 days to figure out each stock's volatility.
So instead of looking at just the closing prices, he's looking at the range of prices during that period.
Exactly. It's a more accurate way to capture how much each stock jumps around.
Okay.
Based on this, he adjusted how much to buy or sell of each stock.
So if Dell was breakdancing more, you'd hold back a bit on Dell.
Precisely. Now, looking back, there were only 6 trades over almost 9 years.
Wow, only 6 trades in 9 years. That's not exactly day trading.
Remember, this is a longer-term strategy,
Right.
and the results were good. The overall return was over 11% per year.
11% per year. That's pretty good.
It is. And what's interesting is those trades actually reflected the real-world performance of those companies. Dell was on fire in the early years, but HP caught up and surpassed them.
So the data was telling a story.
Yeah. And we were able to profit from that story.
That's really cool.
It is. And this example shows you can combine pairs trading with longer-term trend trading.
So you're playing multiple angles.
Exactly. But let's move on to an example that wasn't as successful.
Okay.
The gold-silver ratio.
Okay, the gold-silver ratio. What happened there?
Well, it used to be a go-to trade, but it's run into some trouble lately.
Mhm.
Traditionally, it was believed that a ratio of 35 to 1 was the norm, meaning gold traded at about 35 times the price of silver.
Right. I've heard that was based on the old fixed prices of gold at $35 an ounce and silver at $1 an ounce.
Exactly.
Yeah.
And that's part of the problem.
Okay.
That relationship has shifted.
It's like using an old map to navigate a changing city.
Exactly. Gold now trades at over $1,200 an ounce, and silver is around $20.
Mm-hmm.
So that's a ratio of 64 to 1. not 35 to 1.
Mm-hmm.
Plus, the role of gold and silver in backing currencies has changed, and gold has new industrial uses.
So those old relationships can change.
Exactly.
And you can get tripped up if you rely on past patterns. But wasn't there something big that happened in the silver market?
Yes. The Hunt brothers attempt to corner the silver market back in the 1970s.
Mm-hmm.
They tried to buy up as much silver as possible, hoping to drive up the price.
Wow, did it work?
For a while, it seemed like it might.
Mm.
Silver soared from around $6 an ounce in 1979 to almost $50 an ounce in 1980.
Mm-hmm.
The gold-silver ratio plummeted to 16 to 1.
Oh, wow. So silver was briefly more valuable than gold.
Exactly. It was a period of extreme volatility.
Yeah.
But as you can imagine, it couldn't last.
Right. What happened? Did they run out of money?
Well, it's a complex story, but a mix of factors brought their silver empire down. Exchange rules changed, they had to put up more collateral, and other investors started betting against them.
So it's like a game of financial musical chairs.
Exactly. Silver prices crashed, leaving many with heavy losses.
Wow. So it shows even the biggest attempts to manipulate the market can fail.
It does. But how did this affect the gold-silver ratio?
Yeah.
Well, it threw a wrench into the whole thing. The historical patterns were disrupted,
Okay.
and the ratio became much more volatile and unpredictable.
So even though gold and silver still move together, that connection isn't so reliable anymore.
Exactly. It's a lesson for anyone clinging to historical ratios without looking at the bigger picture.
Right. And that leads us to our final example.
The London Metal Exchange metals.
Okay, the LME metals.
Yeah, where we see another twist in the pairs trading story.
Okay, so the LME is where all those industrial metals like copper, aluminum, zinc, all that stuff that goes into building things is traded, right?
Exactly. And because these metals are often used together, their prices tend to be correlated.
Mm-hmm. So they seem like good candidates for pairs trading.
Yeah, on the surface. Now, Kaufman found that while they are correlated,
Okay.
they don't snap back into their usual price relationships quickly enough for short-term trading.
Oh, so even though there's a connection, the price movements aren't fast enough for a quick in and out strategy.
Exactly. And it highlights that not all correlated assets are equal.
Right.
You need to consider each market.
It's like choosing dance partners. Some are great for a quick tango, others need a slow waltz.
Perfect analogy.
Yeah.
And this brings up another aspect of pairs trading trend following.
Trend following.
Yes, sometimes instead of betting on prices converging, it's smarter to ride the wave together.
Okay, so trend following. How does that apply to pairs trading?
Instead of focusing on temporary divergences, we look for signals that both assets are trending in the same direction.
Got it. So instead of waiting for the dancers to come back together, we're joining them on their journey.
Exactly. We're harnessing the power of their momentum,
Mm-hmm.
and since they're correlated, their moves might reinforce each other,
Okay.
leading to bigger swings.
That sounds kind of exciting. But how do we spot those trend signals in a systematic way?
We could use tools like moving averages.
Okay.
For example, we could look at the 80-day moving average of both aluminum and copper.
Why 80 days specifically?
It's just a commonly used time frame for spotting medium-term trends.
Gotcha. So if both are trading above their 80-day moving average, that's a signal to buy.
Exactly. And if they're below, it could signal a downtrend.
So it's like they've both agreed on which way to move.
Exactly. What about risk, though?
Yeah, trend following seems risky if things suddenly change direction.
You're right, risk management is crucial.
Mm-hmm.
One approach is trailing stop-loss orders.
Trailing stop-loss orders.
Yeah, it's like a safety net that moves along as the trend progresses.
Oh, I see.
It limits potential losses if the market reverses course.
So it's like having a safety harness while riding the wave.
Exactly. It's not foolproof, but it helps.
This is really starting to come together.
Wow.
Pairs trading really is a strategy. It's not just random.
Absolutely. It requires planning, execution, and risk management. But it can be a powerful tool for boosting returns.
This has been an awesome deep dive into pairs trading so far. We've gone from those basics to exploring those different signals and risk management approaches. We even looked at those cross-market opportunities and custom indices. But before we get ahead of ourselves, I think it's important to focus on some of the practical considerations.
Yes, the nitty-gritty details.
Yeah, what separates the pros from the amateurs? What are those crucial nuances that can make or break a pairs trading strategy?
Well, one of the biggest pitfalls I see is overlooking data quality.
Data quality.
Yeah, remember, pairs trading relies on that historical price data to spot those correlations and divergences. So garbage in, garbage out right.
So bad data can mess things up. It's
Right.
like building a house on a shaky foundation.
Exactly.
Yeah.
You need reliable sources and consistent data.
Gotcha. So data quality is key. What other practical aspects should we be thinking about?
Transaction costs.
Transaction costs.
Yeah, those are often overlooked. Pairs trading can involve frequent buying and selling.
Right, all those little
Uh,
fees can add up.
exactly.
Yeah.
You need to factor those costs in when you're deciding if a trade is worth it.
Mm-hmm. So being realistic and looking at those numbers.
Precisely.
Yeah.
What about testing strategies before we risk real money?
Yeah, that's a good point.
That's where back testing comes in.
Bag testing.
Yeah, it's like a simulator for your trading strategy. You can test it on historical data.
So we can rewind the market.
Yeah, and see how it would perform.
That's cool.
It is. And while past performance doesn't guarantee future results,
Right.
it could give you confidence and help you fine-tune your approach.
So there's a lot of testing and tweaking involved in pairs trading. It's not a set it and forget it thing.
Definitely not.
Yeah.
Successful pairs trading needs ongoing monitoring and adjustment.
So it's like being a gardener, always pruning and weeding.
Exactly.
Yeah.
It takes patience, diligence, and adaptability.
We've talked about beta quality transaction costs, back testing, and constant monitoring. That's a lot. But there's another practical aspect that I think is often overlooked. Emotional discipline.
Ah, the mental game.
Yeah, trading can be really tough emotionally.
It can. You're dealing with real money, and the market's going to test your nerves.
Right. It's so easy to get excited when you're winning and then panic when things are going bad.
Exactly.
Yeah.
And those emotions can lead to bad decisions.
Hmm.
You can throw your plan out the window.
So how do we stay cool-headed amidst all that chaos?
Well, having a clear trading plan and sticking to it is crucial.
Mm-hmm.
Your plan should outline everything.
Okay.
Entry and exit criteria, risk management, rules, your goals.
So it's like a roadmap for our trading journey.
Exactly. It helps you stay on track when those inevitable detours pop up.
But having a plan is one thing, sticking to it when the market's going crazy is another.
Right. That's where the discipline comes in.
Okay.
And one way to develop that discipline is by keeping a trading journal.
A trading journal.
Yeah. Record your trades, your thought process, your emotions.
Mm-hmm.
It can help you learn from your mistakes.
So it's like a therapist for trading minds.
Exactly. It's about building those healthy habits.
This is a good reminder that pairs trading is about mastering our minds as much as it is about mastering the market. But let's shift gears back to those cross-market opportunities we talked about earlier.
Yes, cross-market trading opens up a whole new world.
Mm-hmm.
It allows you to go beyond just stock-to-stock pairings.
Okay, remind me, what exactly is cross-market trading?
It's about pairing assets from different markets, but that have an underlying connection.
Right, like pairing oil with energy stocks or commodities with currencies.
Exactly. Instead of two dancers from the same studio,
Mm-hmm.
we're looking for pairs from different dance styles, but moving to the same rhythm.
I like that. But finding those connections across different markets seems challenging. Where do you even start?
It does require a deeper understanding of how those markets influence each other.
So you need to be able to connect the dots.
Exactly. See how changes in one area affect another.
So we need to be a little bit of an economist.
You could say that.
Okay, so let's say I'm interested in pairing crude oil with energy company stocks. What should I be thinking about?
First, analyze the correlation between oil prices and the energy companies you're looking at.
Right, make sure they generally move in the same direction.
Exactly. Then you have to understand the dynamics of each company.
What do you mean?
What are the production costs?
Mm-hmm.
Do they have their own refining capacity?
Okay.
How much do changes in oil prices affect their bottom line?
So it's not just about general correlation. It's about how that company operates within the market.
Precisely. You also need to consider those broader trends and potential disruptions.
Okay.
What's happening geopolitically?
Mm-hmm.
Are there any new government policies that could impact things?
So cross-market trading adds another layer of complexity, but also more opportunities.
Absolutely. It allows you to diversify and potentially enhance those returns.
We also briefly mentioned pairing commodities with currencies. What's that all about?
Commodities and currencies often reflect macroeconomic trends.
Mm-hmm.
Take gold and the U.S. dollar, for example.
Okay.
They often move in opposite directions.
Right. I've heard when the dollar weakens, gold goes up. Is that because gold is priced in dollars?
That's part of it.
Okay.
But gold also has that safe haven appeal.
Mm-hmm.
So during times of uncertainty, investors flock to gold.
So if you're expecting the dollar to decline, pairing gold against it could be a good strategy.
It's a possibility, but remember, you need to analyze the relationship.
Right.
Consider the current market and manage your risks.
Okay, so we've got those cross-market pairings with stocks and commodities, and even commodities with currencies. It really opens things up. But you also mentioned something called index arbitrage. What's that all about?
Index arbitrage is focused on exploiting price differences between an index and the securities that make up that index.
So it's like finding a pricing error in a gift basket.
That's a great analogy.
Mm-hmm.
The price on the basket doesn't match the value of the stuff inside.
Right, and you could snag that mispriced gift basket.
Exactly. Index arbitrageurs aim to do just that.
But how do they do that? It sounds complicated.
It can be. It often involves complex algorithms and high-frequency trading.
So not something I can do on my phone.
Probably not. It's very specialized.
Okay, so index arbitrage is for the pros with the fancy algorithms. But you mentioned a more accessible approach that involves creating your own custom index.
Yes, this is for those who want to be more hands-on.
Okay, tell me more.
Let's say you're interested in precious metals.
Huh. Okay.
You could create a precious metals index by choosing a basket of mining stocks.
Like Barrick Gold Newmont Mining.
Exactly. You then decide how much weight each stock has.
Mm-hmm.
You can weight them equally or based on their market cap.
So I'm building my own mini ETF.
That's a good way to think about it.
Huh?
Once you have your index, you can look for arbitrage opportunities.
By comparing its performance to those individual stocks.
Exactly. If a stock is lagging behind your index, it could be an opportunity.
So you buy that stock and short your index.
Exactly. It's like creating your own pair trade.
This is pretty cool. It's like being your own hedge fund manager.
It is. But we need to talk about risk management.
Right. Risk the elephant in the room.
Exactly. What are the risks in pairs trading, especially with these more advanced strategies?
Lay it all out for us.
Well, one of the biggest risks is that the correlation breaks down.
What happens then?
If those prices diverge instead of converge, you lose money.
So we need a backup plan. How do we handle it when the correlation disappears?
Stop-loss orders are essential.
Okay.
They limit your losses,
Yeah.
and diversification can help.
So spreading your bets just in case one of your dance partners goes solo?
Exactly.
Okay.
But there are other risks, too,
Yeah.
especially with cross-market trading.
Like what?
Those unexpected events.
Give me an example.
Let's say you're pairing oil with ExxonMobil.
Mm-hmm.
Everything's going well, and then boom, a major oil spill.
Oh, that would be bad.
Even if oil prices stay the same, ExxonMobil's stock could plummet
Mm-hmm.
because of all the damage and legal issues.
So our trade could go bad even if the correlation was right.
Exactly. You can't predict everything,
Right.
but you can stay informed and use tools like options to hedge.
So it's like insurance for your portfolio?
Exactly.
Mm.
You also mentioned tracking error.
Mm-hmm. In index arbitrage, what is tracking error?
It measures how closely an index tracks the performance of its underlying securities.
Mm-hmm.
Ideally, they should move perfectly together,
Mm-hmm.
but there's often a slight difference.
Okay, but why is that a risk?
Well, if you're trying to profit from those tiny price discrepancies,
Yeah.
you need to be sure the index is accurate.
Right. If it's not accurate, it's not a reliable guide.
Exactly. It's like using a broken compass.
So how do we check that tracking error?
You can look at the index's history,
Okay.
and you can compare it to similar ETFs or your own custom index.
So do a quality check before we use it.
Exactly. You don't want to rely on a faulty tool.
This has been an awesome deep dive into pairs trading. We've learned so much.
They have.
But as we wrap up, I want to highlight one of Kaufman's key takeaways, adapting to changing market conditions.
Yes, markets are always changing.
Mm-hmm. What worked in the past might not work in the future.
Exactly.
We need to stay flexible and keep learning.
Absolutely. Trading is a continuous learning experience.
Mm-hmm. It's a journey. So let's summarize some key takeaways for our listeners.
Okay.
Pairs trading is not a get-rich-quick scheme.
Right.
It's sophisticated and requires planning, execution, and risk management.
It's not random. It's about understanding relationships and managing risk.
And it's not about blindly following correlation.
Right.
We need to adapt. What about choosing the right pairs?
Well, correlation's important, but you also need to consider volatility, liquidity, trading costs.
All those details matter.
Yeah.
What about knowing when to make a trade?
We discussed the momentum difference method and Kaufman's stress indicator.
Mm-hmm.
And remember, backtesting can help you gain confidence.
Mm-hmm. But past performance doesn't guarantee future success.
Exactly.
The market is always full of surprises. One more thing, emotional discipline.
That's key.
We need to avoid those impulsive decisions.
Right.
We need a trading plan and a trading journal to keep us on track.
It's about understanding yourself and your reactions.
Mm-hmm. This deep dive has been great, and I'm sure our listeners are ready to explore pairs trading even further.
I hope so.
But before we sign off, I have one final question. We've talked about how pairs trading works, but not who it's for. Is it for everyone, or are there certain types of traders who would really benefit?
That's a great question. It's definitely not for everyone. Let's think about who would be a good fit. Someone who enjoys data analysis.
Mm-hmm.
Someone who's comfortable crunching numbers.
So not someone who just goes by gut feeling.
Right. It's for the people who like to dig into the data
Mm-hmm.
and make decisions based on what they see.
Yeah. And since pairs trading can be, pretty active, especially with those short-term opportunities, someone with, a higher risk appetite would probably be a good fit.
Right. If you're averse to big swings, pairs trading's not for you.
Mm-hmm. It's like riding a roller coaster.
Yeah.
Gotta have a strong stomach.
Exactly. So we've got the analytical mind, the strong stomach.
Yeah.
What else?
Yeah, what else makes someone a good pairs trader?
Well, patience and discipline are essential. Pairs trading is not a get-rich-quick scheme.
Right. It's about consistency.
Exactly. Finding and exploiting those small opportunities.
Not trying to hit home runs.
Precisely. It takes patience to wait for the right setup, and then the discipline to stick to your plan even when things get crazy.
So the right mindset is just as important as the technical skills.
Absolutely.
Absolutely.
Trading psychology is huge in any style,
Right.
but especially in pairs trading, where your emotions can really hurt you.
It sounds like pairs trading is more like a marathon than a sprint.
That's a great way to put it.
It takes endurance.
It does. And the journey of learning pairs trading is a marathon, too.
So it's not something you just learn over a weekend.
No, it's a strategy that rewards those who are committed to continuous improvement.
Mm-hmm.
The markets are constantly evolving.
Right.
You need to keep learning to stay ahead of the game.
So it sounds like pairs trading is for those who really enjoy the challenge.
Yeah.
Those who like the data, the analysis, and who are in it for the long haul.
Absolutely. You'd be intellectually stimulating and rewarding, but it's not for everyone.
This has been a fantastic deep dive. We've covered so much.
We have, from the mechanics to the trader profile. It's been a pleasure.
The pleasure was all mine. Before we wrap up, I want to leave our listeners with one final thought to consider. As technology keeps evolving, what do you see for the future of pairs trading?
Oh, that's a great question. I think we'll see even more advanced algorithms, faster execution speeds, and maybe even new pairing opportunities.
It's an exciting time to be in the markets.
It is, especially for those who could use technology to their advantage.
Absolutely. Well, this has been great, and we hope our listeners are feeling inspired to learn more about pairs trading.
Thanks for having me.
And to all our listeners out there, keep exploring, stay curious, and happy trading.